Hi, it's Kelly with Expert Advisors Group, and the topic I want to share with you today is 1031 exchanges. So under Section 1031 of the United States IRS Code, a taxpayer may defer recognition of capital gains and related federal income tax liability on the exchange of certain types of properties, which is a process known as 1031 exchanges. So this short video will provide you with information that will assist you in making the decision as to whether or not a 1031 exchange makes sense for you in your upcoming real estate transaction. So as always, anyone who is interested in learning more about 1031 exchanges should always seek tax advice. So let's start with the first question that I always get asked is, how does the tax deferral of Section 1031 work? So the tax code provides that the gain or the disposition of certain types of property is not recognized if that property is exchanged for a property of a like kind. So in general terms, the taxpayer disposes of his or her currently owned property, also known as the relinquished property, for the other property acquired in the exchange, which we call the replacement property. So the value of the replacement property must be equal to or greater than the value of the property that's relinquished in the exchange in order to obtain complete tax deferral on the property. So the value for these purposes is generally the purchase price adjusted for closing costs. So let's walk through an example of this for you. So if a taxpayer relinquishes a property for a purchase price of $100,000 and they incur closing costs of $7,500, that taxpayer must acquire a replacement property having a value of $92,500, which is the purchase price less closing costs. And the value of the property acquired is the purchase price of the replacement property plus the closing costs that are incurred in that transaction. So the consequence of acquiring replacement property of a lower value than the relinquished property is that the difference in the value is taxable and it's not deferred. So while the tax liability on disposition of the property is deferred, the basis of the replacement property is carried over from and equal to the basis of the relinquished property, plus or minus any adjustments related to the value of the property acquired and whether or not that value is equal to, less, or more than the value of the relinquished property. So next, let's talk about the timelines of when the replacement property must be acquired. So the regulations require that the taxpayer has to identify one or more replacement properties within 45 days following the closing of the relinquished property. And there are several rules that govern the number of properties that a taxpayer may identify. The 45 days are counted starting with the first day following the closing, and it ends at midnight of the 45th day. And the taxpayer must acquire all replacement property within 180 days following the closing on the relinquished property. So similar to the identification rule, the 180 days are counted starting with the first day following the closing and then ends at midnight of the 180th day as well. So if you would like more information on 1031 exchanges, please reach out to us for a complete list of our preferred partners who can assist you. Thanks so much, and I'll talk to you soon.